Welcome to our video on interest rate risk in the banking book. We'll explore its definition, implications, and management strategies, focusing on how changes in interest rates can impact a bank's capital and earnings. Interest rate risk in the banking book, or IRRBB, poses a significant threat to a bank's capital and earnings. It arises from adverse movements in interest rates affecting the economic value of assets, liabilities, and off-balance sheet instruments. There are two primary methods for valuing banking book items: amortized cost and fair value. Amortized cost is based on initial cost minus depreciation, while fair value relies on market prices or discounted cash flows. For items held at amortized cost, market interest rate changes don't significantly impact profit recognition. However, fair valued instruments can vary significantly due to external factors, affecting both profit and loss and equity. IRRBB economic value measures estimate changes under shocks and stresses. It's crucial to note that a loss in economic value doesn't automatically equate to accounting losses, especially for assets held at fair value. Interest rates consist of several components, including the risk-free rate, market duration spread, and market liquidity spread. These elements influence the rates banks earn on assets and pay on liabilities. Market credit spreads and idiosyncratic credit spreads are also part of interest rates. They represent the credit risk premium required by market participants for a given credit quality, affecting overall interest rate risk. IRRBB is primarily driven by changes in market interest rates, affecting yield curves' shape, slope, and level. These changes can impact a bank's income and economic value, necessitating effective risk management. CSRBB, or credit spread risk in the banking book, is related to IRRBB. It arises from changes in market perception about credit quality, amplifying risks from yield curve changes and requiring monitoring and assessment. Gap risk, basis risk, and option risk are fundamental aspects of IRRBB. Gap risk arises from timing differences in rate changes, basis risk from different rate indices, and option risk from embedded options in financial instruments. Managing IRRBB involves measuring potential impacts on earnings and economic value. Earnings-based measures focus on changes in expected earnings, while economic value measures assess changes in net present value. Earnings-based measures analyze the impact of interest rate changes on future earnings, focusing on net interest income. They consider new business and are suited for short to medium-term risk assessment. Economic value measures assess the theoretical change in net embedded market value. They focus on existing balance sheet items and are influenced by assumptions about cash flows and discount rates. Quantifying IRRBB involves assumptions about interest rate shocks, option exercise, and non-maturity deposits. These assumptions impact risk quantification and require careful consideration in scenario design. Behavioral options require complex analysis due to unpredictable customer behavior. Banks model their books to manage redemption or extension risk, adjusting hedge positions based on expected cash flows. Non-maturity deposits, NMDs, are liabilities without a set maturity date. They provide stable funding but require careful management to stabilize earnings and mitigate risk from interest rate changes. Banks manage NMDs by identifying core deposits and matching them with assets to stabilize earnings. This involves a trade-off between protecting earnings and exposing economic value to interest rate shocks. Equity capital represents structural risk and endowment return. Banks stabilize earnings from equity-funded assets using techniques similar to NMDs, balancing earnings volatility and economic value risk. Economic value measures like PV01, EVE, and EVAR capture interest rate sensitivity. They provide insights into gap risk, yield curve risk, and basis risk, helping banks understand embedded risks in the banking book. Gap analysis allocates interest rate sensitive assets and liabilities to time buckets, measuring the difference between them. It provides a visual impression of risk exposure but doesn't quantify it. Earnings-based measures assess changes in net interest income over a short time horizon. They consider future business and are sensitive to assumptions about customer behavior and management responses. Interest rate shock scenarios are derived from historical data and global parameters. They help banks assess parallel and non-parallel gap risks, ensuring a prudent approach to managing interest rate risk. Thank you for watching our video on interest rate risk in the banking book. We hope you gained valuable insights into its definition, components, and management strategies to mitigate potential risks.